Good afternoon, everybody. Fred Hensler here. Hope everybody's enjoying the holidays. I wanted to take a moment and bring on one of the associate directors of research and a portfolio manager, Matt Watson, to discuss what's been going on in the market. As a professional that's been doing this for many, many years, we have seen times when clients become very concerned about what's going on in the market, and we wanted to address those situations to make sure that you had a level of comfort in the market and with how your portfolios are being handled. So, with that in mind, I've asked Matt Watson to go ahead and join us. Matt, I'll tell you what, it's been a wild sleigh ride. It's been like sitting next door to Santa Claus on the sleigh with the reindeer jutting all over the place. What's going on as far as the investment markets are concerned right now?
Well, Fred, first let me say we want to wish you and all of your clients a happy holidays, and it's a pleasure to be with you today. And we're happy to, of course, talk with you and kind of go over what we're seeing. As you mentioned at James, we've been doing this for many decades, and so we've got a lot of experience with these types of markets. And again, happy to share our thoughts with you. So, as you mentioned recently, it's been a very volatile ride, and we're actually experiencing one of the worst December months actually in the history of the stock market, believe it or not, going clear back to 1931, which was actually the Great Depression. I think we're pretty close to that record of a down December month. We're not quite there yet, but of course the month is not over yet either. So it's very natural for clients to be very concerned today. Again, just by the data that backs that up with the performance of the December month. Now, having said that, this is something that we have been anticipating at James, and we've been positioned conservatively because of that. Back in the summer months, even or at the earlier part of this year, when we had a nice downturn in towards the end of January, into February, we were positioned there. We did some buying coming out of that, and then we became conservative again towards the latter part of this year, especially into that third quarter time period. I think the all-time high in the market was close to September 28th, and it's been a pretty wild ride since then. So, in the short, sentiment was very bullish. Towards the end of September into that October time period, and valuations were very, very high. The good news is both of those have moderated. Sentiment is actually, I think, pretty bearish today, and we'll talk a little bit more about that. But from a long-term perspective, valuations are still pretty elevated. But I think in the short run here, to make a long story short, we could see a nice rally.
Well, you mentioned a bear market, and it seems like every time you turn on the television and listen to one of the talking heads there, now they're telling us that we potentially could be entering into a bear market. Um, can you go ahead and explain what we could expect if, in fact, that's the case? And what James Investment Research thoughts are? Are we actually entering into a bear market, and should we have some concerns about that?
Sure. Well, I would say that most of the major indices are actually already in bear markets. If you look at the transportation index, I think that's down over 20%. The Russell 2000 down over 20%. We really started to see a lot of divergences in the earlier part of this year when international stocks were down a lot more than U.S. stocks, and eventually that seemed to catch up to the U.S. equities. And so even divergences between small and large in the United States was also sort of one of those canaries in the coal mine that we pointed out in our research leading up to this. So I think if I think we're pretty close to a bear market, if not already there in the Dow and the S&P. So James has been in the past one of the best money managers in the country, frankly, to sort of toot our own horn a little bit there. Back in 2008, we held up very well for clients compared to the stock market as well. We held up well in the 2000 and 2002 time period. So, capital preservation is sort of our mantra, here at James. And 10 years into the bull market, people started to forget that. but
Sure
and
enough.
yeah, and maybe people started to ignore that and extrapolate those great times into the future. But here we are again. So we think that again, capital preservation is key. Defense is important because it doesn't take a whole lot of offense to overcome small losses. But if you have large losses, it can take a while to recoup those. So, and active management, that's another thing we're known for here at James. And so we've actually been adding a small amount to portfolios here at these oversold levels. Again, counterpunching when we can and trying to, earn the best risk-adjusted returns we can for clients.
Absolutely, absolutely. And you had mentioned in regard to the bear market and the bull markets obviously being times when investments increased in value over a substantial period of time. You and I have both been around for a long time. I remember in 2000 to 2002, and again in 2008, people really got whipsawed. And what I saw with so many of our contemporaries in this industry, there was often, I called it the excuse of, well, just hang on. Well, that's because people or advisors didn't have anything else that they could offer but to just hang on and hope it recovered. And many of us forget that it took almost 9 years to recover from the last time that this happened for those investors who may not have utilized a conservative based investment like James Investment Research. Now, with that said, I know I'm getting some conversation with individuals who are not particularly clients of ours that are saying, gosh, I see 2008 all over again, and I'm just going to bail and get out of the market. Is that a good strategy at this particular point in time?
We don't think so. No, we think that that's a very risky strategy actually if you do that because again you tend to see very very strong rallies in bear markets. Believe it or not, the bear market rallies tend to be even more vigorous than bull market rallies. Because equities can get pushed to these deeply oversold levels like we're seeing today, in fact, and so we wouldn't be surprised to see a 5 or 10% rally from here at these levels, even over a very, very short time frame. So that's why we never recommend clients, we're more of a balance manager. We never would recommend clients to get completely out, even for very, very conservative clients, because the market's not rational, and we don't treat it as such. And we've learned over many decades of managing money that it's best to move slowly and to try to buy on weakness and sell on strength, and to do that over a period of months in the long term, because bear markets can last for months. And so, our director of research, David James, likes to say that the stock market doesn't go straight up or straight down. Typically there's more of a sawtooth pattern in both directions. So, we've developed over 100 indicators that we use on a weekly basis to try to put our clients in the best position to benefit from those rallies, and that's kind of what we're seeing today.
Sure. And now I know that there are some fears out there. What if this